the exchange cap for the Swiss franc against the euro. Many averages headed for their sixth day of losses in a row. Joining me right now to talk about that and how to allocate capital in your portfolio, Mark Okada is Highland Capital co-founder. He's Chief Investment Officer as well. Liz Ann Saunders is Chief Investment Strategist at Charles Schwab. Happy New Year. Good to see you both.
Happy New Year.
Thank you so much for joining us. What's your take on what happened from the Swiss Central Bank, Liz? Explain to us why this matters. Obviously, yesterday, massive volatility in the markets, and it's gotten a lot more expensive in Switzerland, that's for sure.
So, the rationale from the SMB's perspective was that it was becoming extremely expensive to defend that cap, and in anticipation of the European Central Bank doing quantitative easing, they decided to pull back on that. Obviously, the move was unbelievably swift and powerful in terms of impact, not only on their own currency, but across the currency markets. And I think the reason why it is having these quick ripple effects is, number one, you've got a lot of margin calls kicking in right now. There is a tremendous amount of leverage in currency positions and currency accounts. You've already reported on some of the fallout of this. And there are ripple effects into other markets. When you have losses that are this swift, happen this quickly, and are this extreme, those margin calls can start to filter into other asset classes too. So there's the tentacles into other assets. And I think this is a highly volatile environment. I don't think it's changing, and it's volatility across asset classes.
So Mark, what was the volatility justified? Do you want to play that game, sell into this?
Well, that's been our call for 15. Really, the period now we're entering is a higher vol period. And certainly the surprise that we saw yesterday from the Swiss National Bank on removing the peg was something that no one was calling for. And so it's a big surprise move. It creates an enormous amount of volatility. It does say some positive things about some of the things that we were worried about, specifically around whether Draghi was going to be able to announce QE next week. And certainly I think they're front-running that move and getting out in front of it. But it kind of tells everybody the things that we've got to start to be thinking about as we allocate capital for 2015. And it's this environment we're in that is really driven by central banks that are really hard to call. And so I think that sets up for a much different reality than we have in the last 5 years. The last 5 years have been driven by QE here in the U.S., driven stocks up on average about 15–16%, taken vol all the way down. It's been this nirvana environment for stocks over the last 5 years. The next 5 years, I just don't think we're going to have that sort of environment. We're going to have a much more of a volatile environment, which creates stuff that we're actually pretty excited about. There's a lot of opportunities suddenly to take a bet.
So it gets tougher, but more important to be selective in terms of specific stocks?
Absolutely. Absolutely. So some of the big sectors that we're looking at, energy, right, healthcare, credit, which is one of our biggest sectors, there's suddenly a lot of movers, a lot of things to do in those spaces. And active management, which has been a very tough place to be, right, Liz Ann, over the last several years, is starting to really get some traction. And the returns that we're having, for instance, in healthcare, right, long-short healthcare, been suddenly a great place. Our team is leading the industry in that space, making a lot of great returns, but we're not making a bet that the whole healthcare sector is going up. We're going to make bets that, maybe hospitals are a little over their skis, and maybe medical devices, for example, making a repeal of this tax, it's going to be great for them. So there's going to be winners and losers in those spaces.
What do you think, Liz Ann? How do you position yourself?
I agree. I mean, as I think you know, I'm also chair of the investment committee of Windhaven, which is a subsidiary of Charles Schwab, and we practice the art and science of global tactical asset allocation. And to Mark's point, I think the background conditions were more supportive of passive versus active, and I think that is a market shift this year. I think active tactical asset allocation, particularly across global asset classes, is going to shine a bit more than it has been in this sort of unidirectional, low volatility environment. So I totally agree.
So you think that the indexes underperform active stock picking?
Well, so there's the stock picking within asset classes, which is your bailiwick, not our bailiwick, but there's also asset allocation globally across asset classes. And I think, yes, I think the combination of both, just in general, active is probably going to provide investors a better relative return than it has in the last several years.
All right, certainly it's been tough out there in terms of active. Got to get your take on energy.